Dexia published its first half results on Wednesday, 10th of August 2016. What are the highlights of the period? The economic and financial environment in the first half of 2016 was marked by persistent low interest rates and high volatility in the financial markets. The uncertainty generated by the vote in favor of Brexit increased this volatility and led to a depressed Eurozone interest rates, as well as a growing wariness of southern European countries. This backdrop to the markets was not favorable to Dexia, which is sensitive to changes in market parameters. In particular, it resulted in an increase of the cash collateral paid by the group to its derivative counterparties and is reflected in the financial statements by the valuation of the group's assets and liabilities. Lastly, the Brexit vote temporarily disrupted the refinancing market. In this context, the group adopted a careful management policy to protect itself against the risks of some of these changes. Thus, in anticipation of the possible Brexit, Dexia had carried out 90% of its refinancing program for 2016 by the end of May and had covered its sterling requirements for the months to come. The group also took measures to limit its exposure to changes in exchange rates. This hostile market environment is reflected in Dexia's half-year financial statements with a €200 million loss. Dexia's results are presented in a three-stage analytical segmentation for greater clarity. Recurring income corresponds to the cost of carrying assets. For the half-year, this represented a loss of €131 million, whilst it includes all contributions and taxes due for the year with a total of €86 million. The portfolio income remained stable. However, the market context weighed on financing costs, which slightly increased over the period. Restated for taxes and contributions, operating costs are in line with previous periods and continue to be tightly controlled. The cost of risk is very low for the half-year at just 1.7 basis points. Accounting volatility items correspond to value adjustments for certain assets and liabilities, mainly as a result of changes in market parameters. They do not represent gains or losses in cash terms. Against the backdrop of difficult market conditions, these adjustments have a negative impact for the half-year. The contribution from non-recurring items is positive, mainly representing gains on the sale of assets or liabilities redemption, as well as write-backs of provisions for claims. The decreasing interest rates environment, combined with changes in exchange rates over the half-year, increased the group's balance sheet total to €236 billion. However, this rise covers a decline in the asset portfolio over the period. The Common Equity Tier 1 ratio slightly fell to 15%, mainly driven by the deduction of 60% of the non-sovereign AFS reserve from regulatory capital since the 1st of January 2016, but remains above the regulatory minimum. It should be noted that with effect from the 1st of October 2016, the group must also take the sovereign AFS reserve into account in the calculation of its regulatory capital. Dexia continues to manage its liquidity in a wisely manner and maintains a significant liquidity cushion. On June 30th, 2016, outstanding debt guaranteed by the states reached €68.2 billion under the combined effect of the increase of cash collateral paid by Dexia and the reduction of financing raised from central banks. During the half-year, Dexia carried on implementing its orderly resolution plan in order to reduce the systemic risk it represents. The group's asset portfolio shrunk in the half-year as a result of scheduled amortization and the disposal of assets. The group also continued to implement its risk management policy via the disposal of assets. Off-balance sheet items also declined during the period. Lastly, Dexia carried on its work to reduce exposures to sensitive structured credits in France, which have been cut by nearly 60% since 2012.